Thank you for joining us for a quick update regarding the Infrastructure Investment and Jobs Act. My name is Misty Erickson, and I've worked for NATP for over 5 years in the Tax Research Department and have worked at tax offices during tax season. Prior to my employment with NATP, I spent 10 years working for the Minnesota Department of Revenue auditing individual income tax returns, as well as involved in several projects throughout the year. Today, like I said earlier, I'm here to talk to you about the Infrastructure Investment and Jobs Act. So first, we're going to cover some brief history on this bill. It was introduced back on June 4th, 2021. After being stalled out, we saw movement the week of November 5th, and the bill was signed by the president on November 15th, 2021. Among other tax provisions that we'll discuss later, the bill introduced provisions relating to federal highway, transit, highway safety, motor carrier, research, hazardous materials, and rail programs of the Department of Transportation. Today, we'll focus on a few of the key tax provisions. This includes rules for disaster declarations. Brokers will have to report transfers of crypto assets and retroactive provisions to the employee retention credit. So what about that disaster declaration? The first change we'll discuss relates to Code Section 7508A, which are the rules for the disaster declaration where there is a deferred due date of tax returns. First, there is clarification on what date the 60-day time period is based on. The 60 days starts the latter of the earliest incident date specified in the declaration or the date such declaration was issued. So if an event took place first and the declaration was issued second, typically it'll go based on that date the incident was specified. A common thing you're going to see are hurricanes, where the hurricane happened first, the declaration happened second. The Act also provided a list of what actions are included under the extension. Those acts include filing any return of income, estate, gift, employment, or excise tax, payment of any income, estate, gift, employment, or excise tax, or any installment payment for those taxes, filing a petition with the tax court, or filing a notice of appeal from a decision of the tax court, allowance of a credit or refund of any tax, filing a claim for credit or refund of any tax, and bringing suit upon any such claim for a credit or refund. So really what it did is it clarified what actions fall within this declaration. You may also see it as a postponement of dates. We see that term frequently when we're reading those bills and those notices that relate to disaster declarations. Next, we're going to talk about digital asset broker reporting, and think of it as your cryptocurrency. So there's a requirement for broker reporting of digital asset transfers. It was a bit controversial, particularly about the definition of a broker. In this case, a broker includes any person who, for consideration, is responsible for regularly providing any service effectuating transfers of digital assets on behalf of another person. This person will have to report any transactions involving a digital asset on Form 1099-B starting in 2023. This also treats a digital asset, so think of your cryptocurrency such as Bitcoin. It means that it is a covered security. When we're looking at covered securities, this means that the basis or adjusted basis as well as the gross proceeds will have to be reported to the IRS. There is also a broker-to-broker transfer of assets that will have to be reported on a statement, so the receiving broker has the information necessary to report the basis or adjusted basis and gross proceeds on 1099-B. We also saw that digital assets will be treated as cash for reporting purposes on Form 8300, Report of Cash Payments over $10,000 received in a trade or business. So what does this really mean? Well, at the end of the day, if you have a client who is receiving Bitcoin or any other virtual currency as a receipt of payment for, say, their services or a product, and it exceeds $10,000, they have to disclose this information on Form 8300. And when you're looking at the definition of a transactions, it also means related transactions. So even if it's a series of payments related to one transaction, so maybe an installment payment scenario, they're still going to have to disclose this amount, even though the payment itself is under 10,000. Now we're going to get into one of my favorite provisions that happened. And when I say favorite, it's because it's retroactive. And as if you're like me, these retroactive changes can sometimes mean you're pulling out your hair. So we saw this with the employee retention credit. Before we go through the changes, we'll briefly review the history. Congress enacted the ERC, a refundable payroll credit, with the passage of the CARES Act for 2020. Eligible employers who paid qualified wages after March 12, 2020 and before January 1st, 2021 were eligible for a refundable credit equal to 50% of qualified wages paid. The purpose was to help U.S. businesses to meet their payroll obligations and also help retain workers. And at the end of the day, it was also to ensure the viability of their business to continue. So we wanted to keep our businesses up and running. As you all know, we saw changes with the Consolidated Appropriations Act of 2021. So what happened? Well, the ERC was extended through June 30th, 2021. However, there were a few modifications in place. The credit percentage increased from 50% to 70% for the first $10,000 of quarterly wages and health plan expenses paid to the employees in a calendar quarter. This resulted in a maximum credit per employee of $7,000 for each quarter, which was a significant increase of $5,000 per employee for the entire year of 2020. Then we saw some more changes with the American Rescue Plan Act. This extended the ERC from July 1st, 2021 until December 31st, 2021. We also saw Notice 2021-49, which provided additional guidance for us. And it actually stated that the credit is available to eligible employers that paid qualified wages after June 30th, 2021 and before January 1st, 2022, so that extension. It also expanded the definition of an eligible employer to include a recovery startup business. And this is key to our changes that we're going to see. As a reminder, a recovery startup business is any employer that began carrying on a trade or business after February 15th, 2020. There's also an average gross receipts test, which in that case, it cannot exceed $1 million for the 3-year tax period beginning or ending with the tax year that precedes the calendar quarter for which the employee retention credit was determined. And it could not be a business subject to a suspension under a government order or had a significant decline in gross receipts for the calendar quarter. So with that said, we saw our definition, and that is key to one of the changes we're going to discuss. We also saw a modification of qualified wages for severely financial distressed employers and additional guidance on how the credit interplays with the Shuttered Venue Grant and the Revitalization Grant. We will not go into a lot of detail on this as we really want to address what changed with the Act. So what changed? Well, we had a retroactive determination of the credit for fourth quarter, essentially, except for our recovery startup businesses. And they may continue to claim the credit through fourth quarter. So that is key. When you're looking at who is now eligible, it is really only our recovery startup businesses. With that said, we also saw a change of this definition. So what it did is it removed the requirement that the recovery startup business cannot be subject to a suspension under a government order or have experienced a significant decline in gross receipts for the calendar quarter. So what are our impacts with those retroactive changes? Well, the credit was available, and I'm sure a lot of employers went into fourth quarter thinking they're going to be eligible for the credit, and they're not. So what does this mean? Are there going to be penalties for failure to deposit taxes that may apply? We don't know. With no deadline changes, this could also result in taxpayers being out of compliance and owe tax for fourth quarter. All of these areas are things that we're going to keep an eye on. We're going to need additional IRS guidance on this. Are there going to be penalties? Will there be interest? Are they going to waive some of this for those who are banking on being eligible for that credit? So when we said, like I said earlier, since the employee retention credit will no longer be available for qualified wages paid by non-recovery startup businesses after September 30th, 2021, we need to determine what should do. So there could be a recommendation would be for employers who have not deposited their share of payroll taxes or filed in advance of the credit via Form 7200 for wages paid during quarter four to date, hold on taking immediate action. So what does this mean? I mean, at the end of the day, we shouldn't file the form. You're going to probably want to make deposits, try to get them into compliance, especially if they're required to make deposits on, say, a monthly basis or any of that. So at the end of the day, start getting those deposits in place. And then we want, as I stated earlier, we need to really wait and see whether or not interest and penalties on those amounts are going to be waived. We really hope it's going to, and we will keep you up to date if that does happen. Lastly, I'm going to cover a few other key provisions in the Infrastructure Investment and Jobs Act. One was modified rules for postponing certain acts for service in a combat zone. So what you're really looking at is, and if you don't know, there are certain deadline extensions for those who are considered service in a combat zone. I'm not going to go into the explicit definition, but at the end of the day, what you need to know is that the act adds the act of filing a notice of appeal from a tax court decision. The language filing of a petition with the tax court in the act does not contain any limitation or modifiers. And so it is inferred that the extension would cover any petition with the tax court. Any petition would cover such items as a petition to redetermine deficiency, petition for declaratory judgment, petition to review the determination at a collection due process hearing, and others. With that said, the act also extended or added the bringing suit of a U.S. by the U.S. to recover an erroneous refund. So keep that in mind. There was an additional postponement for our military personnel serving in a combat zone. We also saw, in addition to what is a qualified disaster, and in this case, the term significant fire was added to the list of events. What it means is it allows the IRS to suspend filing and payment requires under Section 7508A. A significant fire is any fire for which assistance is provided under Section 420 of the Robert T. Stafford Disaster Relief and Emergency Assistance Act. Any significant fires after the date of the enactment will fall under this provision. I want to wrap up by saying thank you. NATP offers webinars year-round on a wide variety of topics. Go to natptax.com/webinars to see what courses are coming up next. I want to close by saying thank you. Your involvement helps to make NATP successful and contributes to excellence in the tax industry. If you are not a member, this is a fantastic organization for tax pros at every career stage. Depending on the level that you join at, a future webinar may be available at no cost. Learn more at natptax.com/join. Thank you and have a great day.